Hi, let's work through conventional mortgages as a specific type of mortgage.
Years ago, if someone needed a loan, they walked into their small local bank. They sat down with the banker and asked for money. The banker knew the person's history, knew how hard the person worked, knew the person's character. The banker also knew about the person's job and how stable or how risky the person's income was. The banker made the decision of whether to loan the money based on the likelihood of the bank getting paid their money back. What the banker did was to make or reject the loan based on risk. Neither government insured nor guaranteed. A conventional mortgage loan is not guaranteed or insured by the government. Without the backing of the government, the lender assumes all the risk. Non-conventional mortgage loans are backed by the government. They include loan programs offered by the Federal Housing Administration, known as FHA, and the Department of Veteran Affairs, known as VA. Down payment and LTV ratio. The buyer is required to make a down payment to help offset the risk to the lender. The loan-to-value (LTV) ratio is a financial term used by lenders to express the ratio of a loan to the value of an asset purchased. The term is commonly used by banks to represent the ratio of the first mortgage lien as a percentage of the total appraised value of real property. Ideally, lenders want 20% down, leaving an 80% loan-to-value ratio. LTV. As this example shows, a $100,000 purchase requiring 20% down equals $20,000. On a $250,000 purchase, the required 20% down payment would be $50,000. Many homeowners cannot afford 20% down. 20% down payment equals an 80% loan-to-value ratio. This graphic shows that a $100,000 purchase price with 20% down from the buyer would be $20,000, with $80,000 or 80% traditionally coming from the lender. PMI. With a conventional mortgage, borrowers are expected to provide a 20% down payment. This practice lowers the risk of default. However, for borrowers unable to provide a 20% down payment, a conventional mortgage may still be obtained if the borrower agrees to pay the added cost of private mortgage insurance, PMI. Private mortgage insurance, or PMI, covers any of the 20% not put down by the borrower in case of default. PMI increases the cost of the monthly payment. Other qualifying factors would also apply to determine whether a borrower may be eligible for a loan. Private mortgage insurance. The previous example shows the buyer putting 10% down when utilizing a loan, while also paying for private mortgage insurance. This is a common amount of down payment percentage. However, it is also common to see down payments as low as 5% with conventional mortgages. The amount down is negotiated between the lender and the borrower. The less down, the greater the risk to the lender. Greater risk usually equals increased interest rates that are charged as well as an increased PMI cost. Qualifying standards. Loans are made in the primary mortgage market. Loans are then sold in the secondary market. To ensure that loans have a safe amount of risk, standards are in place to qualify a loan as meeting conforming loan standards. Required down payment amounts, loan-to-value ratios, private mortgage insurance, and income to debt qualifying ratios also factor into determining whether a loan meets conforming loan standards. Other loan approval requirements may apply per lender discretion. Total obligation ratio, TOR. Total obligation ratio, known as TOR, is the maximum percentage of debt to income that is allowed as a standard of measurement to qualify for a loan. TOR protects both the borrower and the lender by measuring the total long-term debt a borrower can take on before being approved for a mortgage. To qualify for a conforming conventional mortgage, a borrower cannot exceed maximum total monthly obligation ratio of 36%. To calculate TOR, a borrower's total monthly debt obligations must be determined. This includes all debt reported on the credit report. Child support is included as a long-term debt payment. Expenses such as food, gas, and utilities are not included in the total obligation ratio. The total debt reported on the credit report is added to the cost of the mortgage being sought. The cost of the mortgage includes the amount required to pay principal, interest, property tax, and property insurance. If the person is being charged a fee for private mortgage insurance, this is included. The total debt is then divided by the borrower's monthly gross income. The resulting answer provides the TOR percentage. If TOR is 30% or less, the borrower satisfies the TOR qualifying parameter. Otherwise, the individual would not qualify for the conventional mortgage. So total monthly obligations, including PITI and PMI, divided by monthly gross income equals TOR. Story problem. Walt wants to buy a home with a conventional mortgage. The total payment on the home would be $1,000. His other long-term debt equals $800. This includes a car payment of $525 and total credit cards of $275. Walt's gross monthly income is $3,200. Will he qualify for this home utilizing a conventional mortgage? To solve this problem, you will have to recall the formula for your total obligation ratio. The formula is to take your total monthly obligations and divide it by your monthly gross income to equal your TOR. So first you have to determine your total monthly obligations. In this case, we have $800 in existing debt plus the $1,000 in the proposed house payment to give you $1,800 as the total monthly obligations. So you divide the $1,800 by the $3,200 as the monthly income, which will give you a decimal of 0.5625. We can round that to the percentage of 56%. Remember that the qualifying ratio for TOR for a conventional mortgage is 36%, so Walt does not qualify.
Qualifying ratios. Loan comparison. With so many different qualifying ratios based on the type of loan that's being sought, it's nice to look at it in kind of a column by column manner so that you can compare one type of loan to the other. So in our first column here, we do have our type of loan. In our second column, we have our housing expense ratio, and in our third column, we have our total expense ratio. So for conventional loans, remember that there is no housing expense ratio. Instead, you're only worried about the total obligation ratio. The FHA loan, on the other hand, has a mandatory 31% HER ratio or below and a total obligation ratio for debt at 43% or below. The VA loan, just like the conventional loan, does not have a housing expense ratio requirement and instead allows for up to 41% in the total obligation ratio.
Interest rate. The government does not dictate the amount of interest that a lender may charge for a mortgage. Interest rates are negotiable between the buyer and the lender. However, interest rates are tempered by the supply and demand for money in the capital markets. The more consumers borrow via credit cards, mortgages, and car loans, the higher the interest rate. Interest rates fall as consumers choose to borrow less. Mortgage assumption. When a mortgage is assumable, a new purchaser of the property may qualify to take over the mortgage. Conventional mortgages are rarely assumable as conventional mortgages feature a due on sale clause. This clause requires the mortgage to be paid in full upon the sale of the property. VA and FHA loans do not include a due on sale clause and are therefore assumable. The benefits of assuming a mortgage almost always stem from the buyer's ability to take on the assumed mortgage rate. This is a benefit if the seller's interest rate is lower than prevailing market rates. Additionally, an assumable mortgage helps the purchaser avoid certain settlement costs related to new loans. Prepayment clause. Another important feature of the conventional mortgage is the inclusion of a prepayment clause. This clause allows a borrower to pay off the loan early and without penalty. A prepayment clause is different from a prepayment penalty clause, which may add a penalty when loans are paid off ahead of schedule. Amortized mortgage. Most mortgages are offered based on an amortization schedule of payments. An amortized mortgage provides for a payment that is the same from one month to the next. The amount of the payment covers the principal and interest due for that month. Adjustable rate. A fixed rate mortgage charges the same interest rate throughout the entire term of the mortgage. As a result, the buyer knows the exact cost of the loan and total interest paid should payments be made exactly as the amortization schedule outlines. However, a buyer could also obtain an adjustable rate mortgage.